Welcome, curious minds, to another deep dive. Today we're doing something pretty unique, I think. We're jumping back in time
We are indeed.
to January 10th, 2011. And we're going to unpack the very first annual letter from Fundsmith.
Right, brand new fund manager back then.
Exactly. The fund had only launched, 2 months before? November 1st, 2010.
Just 2 months. It's really not long at all in investment terms.
So this is like a really rare chance to see the foundational thinking of an investment firm right from the absolute beginning.
Yeah, you don't often get this kind of window.
So our mission today isn't just about old market numbers. We want to uncover their, core investment philosophy, maybe dig out some surprising insights. And yeah, apparently there's a good old-fashioned rant in there too.
Always good value.
Right. And while it is finance, the lessons feel broader. Really about how you evaluate information, question things, find value where maybe others just, skim the surface.
And I think what's really interesting for you listening in is precisely that freshness. It's not just what happened back then, but how a totally new player was looking at the market. And maybe more importantly, how they set out their principles, their guiding ideas right from day one. This letter, it's a unique look at that initial vision, before years of market noise kind of creep in. It lets us see things away from the established way of thinking. That's really valuable.
Okay, so let's get into it. The letter itself, it jumps straight into the big question, doesn't it? Measuring performance after just 2 months.
Yeah, they tackle it head on.
The manager says pretty bluntly that 2 months is, and I quote, a ludicrously short period to measure investment performance.
Which it absolutely is.
But they still wanted to give a flavor of the reporting, which is likely to occur in years to come. So even in that tiny window, what did that initial flavor actually show?
Well, okay, for those 2 months, November 1st to December 31st, 2010, the Fundsmith equity fund was up 6.14%. That's net of fees.
Okay. And how did that stack up?
Well, context is key, right? The MSCI World Index, a big global benchmark, was up around 8%. So they were slightly behind that.
Right.
But the MSCI EAFE index, that's developed markets in Europe, Australasia, Far East, that rose about 5.8%.
So slightly ahead there.
Yeah. And the FTSE 100 gained 4.4%. And interestingly, the long bond, the 10-year UK Treasury, actually fell 2.57%.
Okay, so a mixed bag against benchmarks, but definitely ahead of UK large caps and bonds.
Exactly. A decent start, especially given the short time frame.
And that really brings us neatly to sort of a core part of their thinking.
Oh.
Benchmarks themselves, how they view them. They seem to have a pretty strong, maybe even contrarian view compared to many managers.
Oh, absolutely. They're very clear. They say benchmarks are fine, useful for measuring performance over a long enough time. The problem, they argue, comes when managers start using them for building the portfolio.
So constructing it based on the index weightings.
Precisely. They state explicitly, we do not endeavor to track any index or to minimize our tracking error versus any index. In fact, they say the very term tracking error tells you an active manager probably has the wrong mindset.
Wow. Okay, so what does that mean in practice for you, the listener, thinking about their investments? How does that conviction show up in what they actually buy?
It means they're genuinely active,
Yeah.
properly active. They're not trying to just shadow an index or slightly tweak its holdings. They believe that if you just track an index, you end up forced to own businesses you might not actually rate or maybe don't even understand fully.
Right.
Instead, they stick to their own pretty strict investment principles. They pick companies based on, fundamental quality, valuation, not just because it's big or popular or happens to be in the FTSE 100.
It's conviction over conformity.
That sums it up perfectly.
Yeah, and that conviction, it leads us straight to the companies they did choose back then. The letter mentions the main positive contributors included names like Del Monte Foods, Becton Dickinson, Domino's Pizza, Nestle, Stryker.
Some familiar names there.
Yeah, and Del Monte gets singled out, almost like a perfect example of how they find opportunities. What was the story there? What made Del Monte so attractive to them?
Okay, so the fascinating thing is why Del Monte fit their criteria.
Yeah.
It wasn't the canned fruit people might remember. It was its main product, pet food.
Pet food.
Yeah. Fundsmith describes pet food as a small-ticket, consumer, non-durable item.
Okay, break that down.
Well, think about it. You don't need credit to buy it. Customers generally don't haggle over the price. They tend to be really brand loyal. And crucially, you have to keep buying it. Non-durable.
Right, you can't put off buying Fluffy's dinner like you might put off buying a new washing machine.
Exactly. And here's the kicker. They mention research showing that when times get tough, people often cut spending on their own food or even their kids' stuff before they cut back on their pets.
Wow. That's powerful loyalty.
It is. So you've got this great business characteristic, but why was it an investment opportunity?
Good question. Strong business doesn't always mean cheap stock.
Right. Fundsmith's point was that this fact that pet food was Del Monte's main driver seemed to be lost on most investors. People were still thinking about it based on, like, folk memory of the old canned fruit and veg business.
So a perception gap.
A big one. And that misunderstanding, they argued, created the chance to buy the stock at a really good free cash flow yield relative to its likely performance.
They even mentioned some confusion in the news, didn't they? A Bloomberg story mixing it up with a different company.
Yeah, exactly. A story about a strike at Fresh Del Monte Produce Inc., totally separate company, ran against Del Monte Foods, just added to the confusion.
So the lesson from Dilhanti is really about finding value when the market's stuck on old ideas,
Yeah.
overlooking the fundamentals, seeing what others miss.
It's a brilliant case study in that, and, it paid off pretty quickly for them.
How so?
Well, just 18 days after the fund opened and they'd bought their shares, Del Monte got a takeover bid from KKR, the private equity firm, at a big premium.
Okay, so quick profit, happy days.
Well, yes and no. This is where their unique view really shines. They admit it would be, quote, churlish not to like getting a premium,
Sure.
but they immediately add that these events are not without their downside.
Downside to making a quick profit.
Yeah, because now they have cash and they have to find an equivalent investment. Their goal isn't just to flip stocks. They genuinely want to own stakes in these great companies and benefit from the cash they generate over the long term. They're not just playing past the parcel, hoping for a higher price later.
That is a huge distinction. It really underlines that long-term owner mindset. It changes how you even view a takeover bid.
Completely.
And that same deep conviction, that view of owning a business, it also shapes how they talk about something else investors worry about. Price drops.
Right. They advise investors not to get too carried away by price rises either. And similarly, understand that price falls in the portfolio can often be an opportunity, a chance to invest at even better value. Not necessarily a reason for, as they put it, soul-searching and recriminations.
Of course, they add the caveat, often, but not always.
Naturally. They did list a few stocks that detracted from performance in those first 2 months. Circo Group, Imperial Tobacco, Dr. Pepper Snapple, Reckitt Benckiser. But they maintained that the price fall didn't change their view of the actual investment case for any of them, other than wishing they'd bought more at the lower price.
Right.
It didn't reflect, in their view, any adverse change in the fundamental intrinsic worth of the business itself.
Again, conviction in their analysis in that long-term view. Okay, let's zoom out a bit. The portfolio as a whole at the end of 2010, what did it look like?
They held 22 stocks at that point, including Del Monte before the bid finalized. The historic dividend yield on the fund was 2.47%. And importantly, that dividend was covered over 2.5 times by earnings. Solid cover.
And we're most paying dividends.
Yeah, only one stock in the entire fund wasn't paying a dividend. And they highlighted that because dividends have historically been a big chunk of total equity returns.
Makes sense. What are the companies themselves? Any notable characteristics?
This is pretty amazing, actually. The average company in their portfolio was founded way back in 1883.
1883.
Yeah. So these are businesses that have shown, as they say, great resilience over a long period of time. Most survived 2 world wars, the Great Depression, incredible longevity.
That speaks volumes about quality, presumably.
It does. And then there's the cash flow. Their trailing free cash flow yield, the FCF yield, was around 7%.
Just remind us what FCF yield represents.
Sure. It's basically how much actual cash the business generates per share relative to the share price. They see it as a really critical measure of a company's health and its ability to reward shareholders.
Right. Cash you can actually use.
Exactly. Cash that can be paid out as dividends, used to buy back shares, or crucially, reinvested back into the business to generate even more returns. And given their portfolio had an average return on operating assets of 50%.
50%.
Yeah, 50. It means for every dollar or pound these companies reinvested, they were generating 50 cents or 50p in return. That's exceptional compounding power.
Okay, so high FCF yield, incredible reinvestment returns. How did that compare to the broader market at the time?
Good question. They compared that 7% FCF yield to the S&P 500, which was actually a bit less than 7%. The median FCF yield in the S&P was 6.6%.
So their portfolio is generating more cash relative to price than the average U.S. large-cap company.
Correct. And this leads to a very confident statement from them. They say it's inconceivable that their portfolio isn't of higher than average quality.
Inconceivable. Strong word for a new fund.
Very. They list the reasons: longevity, resilience, predictability, profit margins, return on capital, turning profits into cash. On all these metrics, they believe their portfolio is superior.
And yet the valuation, based on that FCF yield, was actually better than the market average.
That's their core argument. Higher quality businesses bought at a valuation that's, if anything, slightly lower than the average market valuation.
So what underpins that confidence just 2 months in?
It really comes down to that deep financial analysis, focusing on the cash flow, combined with the qualitative stuff, brand strength, competitive moats, resilience. Put simply, they believe they own shares in businesses that were demonstrably better than average, bought at prices that were no worse than average, perhaps even better.
They admit it's not a total solution to successful investing, but
It strikes them as at least a good start. And it all comes back to that core belief. An equity share is a claim on the cash flow of a real business.
find companies that make high cash returns, give some back, reinvest the rest wisely, and don't overpay.
That's the recipe. Simple to say, hard to do consistently.
And then they deliver that classic line, setting themselves apart from, well, maybe other approaches.
Ah, yes, the pass the parcel bit.
Right. They say they do not regard equity investment as a sophisticated game of pass the parcel.
In which we buy shares in companies that we don't understand, which may be poorly performing businesses in our door, which are overvalued.
Hoping to sell them to a greater fool when they have become even more expensive as a result of some fad or share price ramp. Ouch.
It's pretty direct. They basically say leave that stuff to video games unless your hobby is losing money whilst investing.
It's quite a statement, isn't it? A real line in the sand against speculative bubbles and momentum chasing really tells you about their mindset.
Absolutely. You can almost hear the frustration with parts of the industry in those words. Sets a very clear tone right from the beginning.
And speaking of strong views and setting tones, they then pivot to something they actually flag they do, a dedicated rant.
The annual rant.
The inaugural rant, about a topic they felt was really important at the time, trying to cut through the noise. And the first topic, ETFs, exchange-traded funds.
Yeah, a stark warning about the misunderstanding and misuse of ETFs.
Why then? Why was that so relevant in late 2010, early 2011?
Well, think about the context. Their active fund launched after a decade where equities, broadly speaking, hadn't done very well. And on top of that, the average active fund manager had underperformed even those poor market returns, making it worse for investors.
Right, so active management had a bad rep.
A really bad rep. So it's hardly surprising investors were looking elsewhere, turning towards lower-cost, passive options like ETFs.
And ETFs were booming then.
Massively. They mentioned figures from Q3 2010, nearly 2,400 ETFs globally, managing over $1.1 trillion. Huge growth.
Okay, so they're popular, seem simple, often low cost. What's the problem? What was Fundsmith's big concern?
Their suspicion was that the average investor just lumped all ETFs together, saw them as just another type of index tracker fund.
And that's not accurate.
Well, they say many are, but many aren't, and therein lies the potential for misunderstanding. Or worse.
Okay, so what's the crucial difference?
It's how they track the index. Some ETFs, often called physical ETFs, actually buy the underlying stocks or bonds in the index. They hold the assets.
Simple enough.
But many others, the synthetic ETFs, don't hold the assets directly. Instead, they use derivatives, typically swap agreements.
Swaps. Okay, how does that work?
Essentially, the ETF provider makes a deal, usually with a big investment bank, the counterparty. The bank promises to pay the ETF the return of the index minus a fee. In return, the ETF provider gives the bank collateral, often cash or other assets.
Nah. Okay, I think I see where the worst part might come in.
Exactly. Anyone who paid attention during the 2008 credit crisis, Fundsmith argues, should immediately spot a potential issue. Counterparty risk.
What if the bank providing the swap goes bust?
Precisely. They point to Lehman Brothers collapsing, AIG needing a massive bailout. This risk isn't just theoretical anymore, it's very real.
But don't they have collateral against that?
They should, but Fundsmith says holding collateral is an imperfect science. It might not always be there, or it might not be enough, or it might be the wrong type. And sometimes there might only be one single counterparty providing the swap. Huge concentration risk.
So, understanding this isn't just finance jargon. It's about Hidden vulnerabilities in what might seem like a simple product.
Absolutely. It's about knowing what you actually own, or in this case, who you're relying on.
Okay, counterparty risk is one major issue with synthetics. What else?
Well, synthetic ETFs are often used to give investors access to markets that are difficult or impossible to invest in directly.
Like what?
Think maybe the Chinese A share market back then, or certain niche emerging markets where the underlying shares might be really illiquid, hard to buy and sell.
Okay.
So the potential for the ETF's performance to kind of drift away from the actual underlying assets or from what investors expect seems pretty obvious. The whole idea that some bank will just perfectly replicate the return of assets you can't even trade yourself.
Yeah.
Fundsmith says that should give pause for thought.
Makes sense. A layer of complexity, another potential point of failure.
Yeah. And then there's another layer entirely. Not all ETFs just track an index one for one.
Right, you get the leveraged ones.
Exactly. Leveraged ETFs that aim to give you, say, double the daily return of an index. Inverse ETFs that aim to give you the opposite return, basically, a short position.
And even leveraged inverse ones. Wow.
Yeah, double short daily return, for example. The massive issue with all of these, Fundsmith explains, is that the leverage or inverse exposure is reset daily.
Daily. Why is that such a problem?
Because of compounding and volatility. It leads to what they call perverse results if you hold them for longer than a single day.
Perverse results. How?
It's down to the maths of daily rebalancing. If the market is volatile, bouncing up and down, you end up crystallizing losses on down days from a higher base due to leverage, and then capturing gains on up days from a lower base.
Okay, so the path matters, not just the start and end point.
Hugely. It's like, imagine climbing a slippery slope. Every time you slide back, you lose ground, and it's harder to get back up, even if the slope itself eventually levels out. Volatility eats away at the returns over time.
They gave some pretty stark examples, didn't they?
They did. Really drives it home. Example 1, an index is highly volatile over 4 days, but actually finishes up 3%.
Okay, index up 3%.
A 2x leveraged ETF tracking that same index over those same 4 days. Because of the daily compounding effect through the volatility, it actually delivers a cumulative loss of 15%.
Wow. A 3% gain turns into a 15% loss. That is perverse.
It gets worse. Example 2. An index bounces around downwards during a week, but ends up exactly where it started. 0 return for the week.
Okay, flat overall, but volatile.
An inverse ETF, just a simple 1x inverse held over that week. Again, due to daily compounding chopping away during the swings, it racks up a staggering 70.5% loss.
70% loss, when the index went nowhere overall.
Yeah, they say they won't even bother illustrating what a leveraged inverse ETF would do in that scenario, you can imagine.
Right. Don't want to think about it. So the message is crystal clear. Unless you are literally a professional day trader watching the screen constantly.
Stay away, far, far away. Treat them like radioactive material.
Unless, as they say, your hobby is losing money very quickly.
Pretty much. The moral of their ETF rant is they bet a huge number of investors using these leveraged and inverse products simply do not realize they can produce these bizarre, counterintuitive results.
They are day trading tools, full stop.
That's the point. Hold them longer than 1 day, and their performance will diverge from the underlying index or asset, often dramatically.
Yet, they suspected many people were just buying them and holding them like regular index funds.
Which is a recipe for disaster. It really hammers home their wider point. Investors might be logical in wanting to avoid poor active management, but many of the passive tools they turn to are not as inactive as they think.
So the ETF takeaway isn't just beware synthetics, it's understand exactly what you own and how it behaves. Simplicity can be deceptive.
Precisely. Know what's under the hood. Always.
Okay, so as we wrap up this deep dive into Fundsmith's very first letter, it's pretty clear, isn't it? Their core ideas were there right from the start. This disciplined, long-term ownership of quality businesses. That really strong contrarian stance on benchmarks and tracking error, and this quite prescient warning about the hidden dangers lurking in certain types of ETFs.
Yeah, absolutely. And I think the key things for you to take away from this are, first, that critical importance of really understanding what you own. Looking past the surface level stuff, the easy metrics, and questioning the assumptions, especially with things like ETFs where that apparent simplicity can hide real risks.
Right.
Remember that difference between physical and synthetic. And definitely remember that chilling point about the perverse results from daily compounding and leveraged and inverse ETFs if you hold them more than a day.
It's a powerful reminder. And it links back to their broader philosophy, doesn't it?
Hmm.
They mentioned wanting to make their fund better every day, echoing Robson Walton's idea for Walmart.
Yeah, continuous improvement.
And that's kind of the goal here with these deep dives, right? To help you continuously refine how you understand the world, making your own information processing, your own analysis better every day, getting to the real substance.
Well said. So maybe let's leave you with a final thought to chew on. It builds on that Fundsmith distinction between truly owning a business and just playing that game of pass the parcel.
Okay.
Think about your own activities, your own pursuits. Could be work, could be learning, could be anything. Are you really owning your understanding? Are you making those long-term value investments in knowledge, properly digging in to find the real intrinsic worth of an idea or a fact? Or are you, maybe inadvertently, just playing a short-term game, passing along information, hoping someone else values the surface-level understanding, without ever truly grasping what it is you hold?
Owning knowledge versus passing the parcel of information. That's a great challenge.
We really encourage you to seek out that deep, intrinsic worth in the ideas and the facts you come across.